Ever wondered if that set it and forget it investment strategy could actually forget your money? We're talking about platforms like Stashaway, the darlings of robo-advising, promising effortless growth. But let's be real, in the world of investments, is anything truly risk-free? Can you, despite all the algorithms and diversification, actually lose money with Stashaway? That's the burning question we're tackling today. Stashaway, for those unfamiliar, is a popular robo-advisor that builds and manages diversified portfolios for you based on your risk tolerance and financial goals. They use algorithms to allocate your investments across various asset classes like ETFs, exchange-traded funds, covering stocks, bonds, and even commodities. The idea is to take the guesswork out of investing, making it accessible to everyone, from seasoned pros to absolute beginners. They market themselves on intelligent automation, global diversification, and low fees, all very appealing, especially for busy individuals or those intimidated by traditional stock picking. They even have strategies like Risk First, aiming to maintain your portfolio's risk level rather than solely focusing on returns. Sounds pretty bulletproof, right? Well, not exactly. The short answer to our question is a resounding yes. You absolutely can lose money with Stashaway. And understanding why is crucial before you commit your hard-earned cash. Firstly, and most fundamentally, Stashaway invests in the market. And the market, as we all know, goes up and down. While Stashaway's algorithms are designed to navigate these fluctuations, they cannot magically insulate your portfolio from market downturns. If the global stock markets take a significant hit, your Stashaway portfolio, even with its diversification, will likely see its value decline. Think about events like the 2008 financial crisis or the COVID-19 market crash in early 2020. No investment platform, no matter how sophisticated, can completely avoid the impact of such widespread economic shocks. Your investments are exposed to the inherent volatility of the underlying assets. Secondly, while diversification is a powerful tool, it's not a silver bullet against all risks. Stashaway diversifies across different asset classes and geographies, which helps mitigate some risk. For example, if U.S. stocks are struggling, perhaps European bonds are performing better. However, in extreme market events, even highly diversified portfolios can experience losses. A global recession, for instance, can impact almost all asset classes to some degree. Thirdly, let's talk about the risk-first approach. While designed to manage risk, it doesn't eliminate it. It aims to keep your portfolio within a certain risk range, rebalancing when necessary. This might mean selling off assets that have performed well to buy those that haven't, or vice versa, to maintain your target risk. While this can help prevent excessive exposure during periods of high volatility, it doesn't prevent losses if the overall market trend is downwards. In fact, during a prolonged downturn, maintaining your risk level might still mean you're holding assets that are decreasing in value. Fourthly, while Stashaway's fees are relatively low compared to traditional financial advisors, they still exist. These fees, though small, can eat into your returns, especially over the long term or during periods of low growth. While they might not directly cause you to lose money in the sense of your principal value decreasing, they can certainly diminish your overall profit. Finally, while less common, there's always the very remote risk associated with the platform itself. While Stashaway is regulated and employs robust security measures, the possibility of operational failures or cybersecurity breaches, however small, always exists. Your funds are typically held with a custodian, separate from Stashaway's operational funds, which adds a layer of protection, but it's a factor to be aware of. So, while Stashaway offers an intelligent and accessible way to invest, it's crucial to approach it with realistic expectations. It's a tool for long-term wealth building, but it's not immune to market forces. Understanding that losing money is a possibility, especially in the short term, is key to being a responsible investor. Stashaway helps manage risk, but it doesn't eliminate it. It's about participating in the market, and with market participation comes market risk. With that said, thanks for watching and until next time.